But let's turn now to how global markets are responding to the trade war. It's been a roller coaster week for European and Asian stocks alongside the U.S. as investors seek clarity around President Trump's trade policies. So where can they find opportunity? For that, we have Jeffrey Kleintop. He is the Chief Global Investment Strategist over at Charles Schwab. Jeffrey, great to speak with you here. Even U.S. consumers seem to be losing faith in the United States, both in terms of their investments, fleeing the bond market at a record pace, and then in terms of their concern about inflation expectations. Where should investors be looking if they want to flee the U.S. right now?
You know, Europe stands out to me. Obviously, the risk of recession is rising in the U.S., but in Europe, it's much less so. Europe's economic exposure to U.S. exports is relatively small. EU goods exports to the U.S. account for only about 3.5% of EU GDP. And so the hit from those tariffs, were they reintroduced in 90 days, might shave maybe 0.5% or so off of GDP. But look, already you've got Germany, which is Europe's largest economy, approving a big defense spending and public infrastructure package amounting to 2.5% of German GDP. That's a big offset. And you've got further spending, a more of a proposal for EU-wide defense spending, more rate cuts from the European Central Bank, cutting the policy rate below 2%. All that fiscal and monetary stimulus may deliver a sizable boost to growth. Remember, Europe's coming out of 2 years of a rolling recession, so there's more growth momentum there, potentially offsetting any drag from exports. And Europe's stock market's reflecting this. It's outperforming the S&P 500 by 18 percentage points.
Jeffrey, good to see you here, but isn't Europe really exposed to what could be a very dramatic slowdown in China?
Possibly. China is a bigger end market than the U.S., but here's what's going on in China. China's got 3 different budgets, but if you combine all of them, you're talking about deficit spending this year of 11% of GDP in China. We've never seen that before. If they follow through, and China has overpromised and underdelivered before, but if they follow through on that level of support to consumer spending within China, the 40 to 50% of China's economy tied to consumer spending could boom, even if the roughly 3% of GDP of direct exports to the U.S. really slumps dramatically. So I think China could actually see domestic momentum economically really improve this year. That could be great news for Europe.
And what does that tell you, Jeffrey, just about the state of play when it comes to all of these global trading partners sort of reallocating who they are allies with? We obviously had the Spanish Prime Minister meeting with Xi Jinping. She is heading to South Africa next week. To what extent do you anticipate a reorder of global trade relationships impacting investment opportunities?
That certainly seems to be underway. As a matter of fact, there's even some talk about examining those electric vehicle tariffs on and quotas on China as they come into the EU. So really a lot of realignment taking place perhaps here as the rest of the world sort of shores up their trading partners as they're worried more about the U.S. And yeah, that could mean different things. Latin America, for example, much more exposed to China than it is to the U.S. Brazil is an economy that exports a lot more to China as well. So we're seeing maybe a reordering of world trade, focusing a bit more on Asia, China in particular.
Jeffrey, it's not lost to me, your founder, Charles Schwab, visited the Trump administration, I believe this week, and I was reminded of how your company has been a champion for the average investor out there for many, many years, in part by Mr. Schwab's efforts. If someone had $1 million in the market today, what do you tell them?
First, panic's not an investment strategy. I mean, hopefully they have a diversified portfolio, but if they haven't, if they've been focused on, let's say, the U.S. tech or AI-focused stocks, the Mag 7 for the last couple of years, it's not too late to consider international investments in their portfolio from an equity perspective, bonds in their portfolio from a fixed income perspective. I know they're suffering today, but they've offered a really great buffer to a really U.S.-focused, tech-focused concentration of the last couple of years. So think about diversification. Not only has it paid off greatly so far this year, but I think it'll continue to do so. And that's why we continue to preach a balanced asset allocation approach to investing and not trying to pick the hot stocks.
And Jeffrey, are bonds still safe in this environment?
A yields may creep a little bit higher, but I think yields are now high enough to offer a bit of a buffer there. So if you look back to, around the follow-up after the pandemic, that surge in inflation, yields weren't high enough to offer a buffer to the decline in price. Now I think it is. So yes, I think bonds can still offer some defense here to a portfolio. I keep those durations short, but we think bonds can still provide some safety in a portfolio.
Jeffrey, I want to get your take on a headline that's just crossing the wires right now. China mulling allowing Western market makers in its ETF sector. Curious from your perspective, if China were to try and lure in American investors with some opportunities like this, how disruptive could that be?
Perhaps. I mean, China has made some steps towards opening up their financial markets. The financial markets in China are not very sophisticated, and investors there, which have more assets, want to be able to invest outside of China. They're looking for opportunities that are a bit more sophisticated than what's being offered to them there. So this has been a slow progress. It's good to see that continuing, but I wouldn't expect anything to change overnight. China moves fairly slowly on these things.
All right, Jeffrey, thank you so much for the great overview. Appreciate it.
Thanks for having me.